For many homeowners, the mortgage is no longer the only bill that determines whether a home still feels affordable. The pressure can arrive quietly, not through a foreclosure notice, not through a moving truck, but through a renewal bill. A cost that once sat in the background becomes large enough to alter the household budget. That is what happened in California, where State Farm General received approval for a 17% interim homeowners insurance rate increase, effective June 1st, 1925. The decision came from the California Department of Insurance and was adopted by Insurance Commissioner Ricardo Lara on May 13, 2025. It applied to State Farm homeowners policies in California and affected roughly 1 million home insurance customers in the state. For those households, this was not only an insurance company story, it was a housing cost story. It showed what happens when the price of protecting a home becomes another rising cost of keeping one. State Farm had asked for more. The company requested a 21.8% increase for homeowners, 15% for renters and condo owners, and 38% for rental dwellings. The approved homeowners increase was lower than the original request, but 17% is still a material increase. It does not remain inside a regulatory filing. It becomes a household number. For homeowners with escrow accounts, it can appear inside the monthly mortgage payment. For homeowners without escrow, it can arrive as a larger renewal bill. For families already managing groceries, gas, utilities, repairs, and debt, insurance becomes another fixed cost that is difficult to avoid. The system behind this bill is homeowners insurance itself. Insurance is not priced around one house in isolation. It is shaped by expected claims, rebuilding costs, catastrophe risk, reinsurance costs, regulation, and the financial strength of the insurer. When a major disaster increases claims, the effect can move through an insurer's balance sheet. When an insurer says its losses are rising, it can ask regulators for permission to raise premiums. When regulators approve part of that request, the cost can eventually reach ordinary homeowners. Risk becomes claims. Claims create financial pressure. Financial pressure becomes a rate filing. A rate filing can become a higher household bill. In this case, State Farm pointed to wildfire-related losses after the Los Angeles area fires. According to the research, the company said that by February 1, 2025, it had received more than 8,700 claims and had already paid more than $1 billion to customers. Later, State Farm said it had handled more than 13,700 auto and homeowners claims and paid more than $5.7 billion to help customers recover. Those figures show the scale of the pressure inside the insurer's system. Their economic meaning is broader. When insurance claims become large enough, the cost may not remain only with the company. It can move into premiums, availability, and household affordability. The California Department of Insurance did not approve the rate increase without conditions. The order also required a $400 million surplus note from State Farm's parent company. That detail shows that the regulator was looking not only at consumer costs, but also at the insurer's ability to pay claims. This is one of the central trade-offs in homeowners insurance. If premiums rise too much, households face more financial pressure. If insurers cannot collect enough to cover expected risk, availability can become a problem. If companies reduce coverage or stop writing new policies, homeowners may face fewer choices. State Farm had already stopped selling new homeowners policies in California in 2023. In March 2024, the company said it would discontinue coverage for 72,000 California homes and apartments. By 2025, the issue had moved from availability to price. The rate increase was not the first warning sign. It was part of a sequence. First, The company stepped back from writing new homeowners policies. Then it moved to discontinue coverage for some existing properties. Then it requested emergency rate increases after wildfire claims. Then the regulator approved a 17% interim increase for homeowners. Each step was different. Together, they pointed to the same underlying pressure. Insurance risk was becoming more expensive to manage. For regular people, that pressure is personal. A homeowner does not experience insurance as a model, a filing, or a balance sheet. They experience it as a bill. They experience it as a call to a mortgage servicer. They experience it as a renewal notice that forces another budget decision. They experience it when the monthly cost of staying in the same home rises, even if the mortgage rate has not changed. This is why homeowners insurance has become part of the middle-class housing squeeze. Housing affordability is often discussed through home prices and mortgage rates. But insurance can change the real cost of ownership after the purchase has already been made. A family may have bought a home years earlier. They may have planned around a fixed mortgage. They may have assumed the largest housing cost was stable. Then insurance rises. Property taxes may rise. Utilities may rise. Repairs may rise. The home does not change. The cost of keeping it does. The State Farm case is a California case. It should not be described as if every homeowner in America received the same 17% increase. That would be misleading. But it does connect to a broader verified pattern. The Government Accountability Office found that average homeowners' premiums rose 3% after inflation from 2019 to 2024. That is the national average. The same GAO research found that premiums rose 25% or more in parts of some southern coastal disaster-prone areas. That difference matters. The national average can look moderate. But in high-risk regions, the pressure can be much sharper. This is one reason the insurance story can feel confusing. A national figure may not match the bill in a specific state, county, or neighborhood. Insurance is local. Risk is local. Regulation is local. Disaster exposure is local. And the household impact is local. A homeowner in one region may see a manageable increase. A homeowner in another region may face a renewal bill that changes the family budget. The story cannot be reduced to one national headline. The consumer view is straightforward. People need insurance to protect their homes. Many homeowners also need it because mortgage lenders require it. That means insurance is not a luxury expense. It is tied directly to the ability to own and keep a home. The company view is different. State Farm said wildfire claims and financial pressure made the emergency rate request necessary. The regulator's view sits between those pressures. The California Department of Insurance approved a smaller interim homeowners increase than State Farm requested, required the $400 million surplus note, and kept the case under review. Consumer Watchdog, a consumer advocacy group, later joined a settlement with the Department of Insurance and State Farm. That settlement kept the 17% homeowners interim rate in place, reduced some other requested increases, and required refunds with 10% interest for some categories retroactive to June 1, 2025. The result is not a simple story of one side winning. It is a story of competing pressures. Homeowners want affordable coverage. Insurers want rates they say reflect risk and claims. Regulators must review those requests while maintaining market stability. Consumer advocates push to limit increases and protect policyholders. In the middle are households trying to understand why a bill they once treated as routine has become a serious financial pressure. Part of the story remains unresolved. As of March 6, 2026, the settlement had been submitted for administrative law judge review. The 17% homeowners interim rate remained in place. Then, on May 4th, 2026, California announced legal action against State Farm after an investigation into wildfire claims handling. State Farm disputed the claims handling allegations. That point must be handled carefully. The allegations are part of the current status, but they should not be treated as final proven findings beyond the regulator's announced action. The central issue is not whether one company explains the entire homeowner's insurance problem. It does not. The more accurate story is how insurance has become one more channel through which risk, disasters, rebuilding costs, regulation, and company finances reach the household budget. The system is complex. The effect can be simple. A homeowner opens a bill. The number is higher. The family has to absorb it. The monthly mortgage payment may change. Savings may shrink. Repairs may be delayed. Another bill may be paid later. The insurance bill becomes part of the same financial pressure many middle-class households already face from groceries, gas, utilities, car costs, rent, and debt. This is why the State Farm case matters beyond one company. It shows how a hidden system becomes visible when the cost reaches the home. For years, homeowners insurance could feel like a background expense, necessary but not central. Now, in some places, it is moving closer to the center of the household budget. The latest verified status is clear. State Farm's 17% interim homeowners increase in California remained in place under the 2026 settlement process. Some related policy categories were reduced under the settlement, with refunds required for certain affected customers. The broader national picture remains uneven. GAO data shows that average homeowners' premiums rose modestly after inflation from 2019 to 2024, while some disaster-prone areas saw much larger increases. That is the current situation. Not every homeowner is facing the same pressure. Not every state has the same risk. Not every insurance market is moving in the same direction. But for the homeowners directly affected, the pressure is real. And the unresolved question is, how much more of the cost of risk may continue moving into the monthly cost of keeping a home?